Welcome to episode 67 of Kontrarian Korner. I'm Ben Kellerin. Today we have a very special guest I've been looking forward to talking with for some time now, and I think it'll be a fascinating conversation on everything from energy, the fourth turning, gold, silver, precious metals, to what's going on with Bitcoin, what's going on with the Fed, and kind of take a big picture view of financial markets and where things might be headed over the next 5 to 10 years. But Luke, thanks for coming on.
Thanks for having me on, Ben. It's great to be here.
Yeah, so I figured we could work backwards a little bit and start with kind of the talk of the fourth turning that's been going around lately. There's obviously geopolitical conflicts going on around the world, some different things that have been flaring up, I guess, over the last couple of years is the way to put it. But I kind of wanted to get into how you kind of see all this stuff really playing out, because I kind of look at the system of government here in the US, and my assumption is that over the next sometime in my lifetime, we'll see a Caesar figure pop up, and we won't be a Democratic Republic or an oligarchy pretending to be a Democratic Republic at some point in my lifetime. But what's your kind of view on how this whole fourth turning plays out? Where do you think things head from here?
I think a really good companion book to the fourth turning is a book called End Times by Peter Turchin, Turchin. And he is by training, he's I believe an entomologist, studied insects. And basically, insects apparently are extremely predictable in terms of how they work in their societies. And so you sort of, had it all figured out by a relatively young in his career, wanted to kind of take on a new challenge. And so he started a field, what he calls cliodynamics, which is essentially the study of like human history cycles. And he identified, as he went back through history, sort of how Strauss and Howe did in the fourth turning. And what he recognized was a pattern where when you had periods of what he called significant wealth inequality, obviously a big feature of fourth turning, but then what he also called elite overproduction, which is you basically, for whatever it looks like in that society, too many college kids, not enough jobs kind of a thing, like we're seeing here. And basically it spawns a group of counter elites who are left out of decision making and feel like they are smarter, at least as smart or at least as well qualified as the ones currently making decisions. And it helps if the ones making decisions are making a lot of pretty bad decisions or bad mistakes. And when you have that, when paired with that wealth inequality, you end up with these types of big disruptions in history. In his book, he says that the last time the U.S. combination of wealth inequality and elite overproduction was as high as it is today was in the 1850s. And obviously the 1860s in the U.S. were a bit of a tumultuous period of time. So I think there is a lot to be said for that sort of cyclical period of that cyclical study of history, the generational theory of history, and that we are in that fourth turning where major sort of institutional things shift, break, etc. And there's a lot of forces pushing those things, be they wealth inequality, be they the rapid pace of technology, be they the discrediting of a large number of institutions that had sort of heretofore been sacrosanct over the last 5, 10, 15 years. So, and it's and then the wealth inequality where, look, the baby boomers and the silent generation of like 60% of the wealth of this country, and they are getting almost 80% of the tax receipts in entitlements and Social Security and partly through Veterans Affairs, but Veterans benefits. So you sort of have, it's like one of these situations where, the difference between a tornado watch and a tornado warning is, tornado watch, the conditions are all there. Tornado warning, you actually start to see the funnel cloud. And so I think we've been in a tornado watch for the fourth turning of increasing sort of severity or risk over the last probably 10 years for sure, maybe 15 years, in terms of getting to the part of the fourth turning where it's really unpleasant, not just a sort of a shift. But I don't think we're in the warning yet. There have been times in the last 5, 10 years where it seems like have potential triggers for the warning, but they've ultimately sort of faded, right? You get ominous clouds and what have you, but no funnels. So we'll see. I do think ultimately at some point you're going to get some sort of fracturing of, I think I would say it as sort of the way we all sort of understand the world to be and have been, our immediate world around us. I think we're going to see some major sort of fractures over the next, it's probably 10 years.
Yeah, I think that kind of lines up with my expectation where things might head. I'll share one of the things I was seeing on Twitter that kind of lines up with what you're talking about with entitlements there. And you kind of see how basically the younger generations are subsidizing older ones, and it doesn't really it's not something that's long-term sustainable, especially, and this is some of the stuff that you've talked about with like the different numbers of people that are supporting Social Security and all this other stuff. But how long do you think, or I guess when do you start to see the cracks as far as real estate or some of these different trends with entitlements? Is it something where, right, boomers are basically gone completely in the next 10 years and that really starts to shift, or you think it's something that happens in steps kind of in the next 3 to 5 years?
I think, some of it depends on how it plays out, but if we just kind of take it in broad strokes, look, ultimately the whatever $70 trillion or whatever that the boomers have, when they die, it's going to their kids, right? So I'm Gen X, early, Gen Xers, early, late Gen Xers, and then early, really all the millennials. They're suddenly going to wake up one day and they're going to be rich. Now, it's not evenly distributed amongst those millennials and Gen Xers. And so, like, on some level, it depends how the pace of it plays out, right? Because if we wake up in 5 years and the sickest 50% of boomers have passed on, well, that means like and silent generation. That means well more than 50% of those entitlements aren't going to be being paid anymore, because there's sort of a lull for a bit in my generation, Gen X, before it starts ramping back up. So, in theory, you would have a situation where you would have a lot of boomer wealth going to their kids into their peak spending years, which would then be taxed as it's spent into the economy, right? So you would see the velocity of 70 trillion in assets that, the boomers have basically piled up like a dragon sitting on their gold. And all of a sudden the dragon dies and that gold flows to their kids, and their kids say, hey, I'm 50 years old. I'm, dropping, 50 grand a year in tuition on college or high school, depending on where you are. And I've got cars and I've got healthcare. I got a mortgage and that money's going to go into the economy. The velocity of that 70 trillion, which, under the most people's lives has been laying very, very still, being built, is going to come back out. And I think it'll be very stimulative. The government will take their rake. And so, paradoxically, like one way you could fix, one way you could see the fiscal situation get fixed much more rapidly than even I think or other people think is like if the sickest half of the boomers passed on quickly. And again, full disclosure, I'm not hoping for that. I don't think it's happening. I'm just describing effects. You would end up with a lot lower outlays in the entitlement side and a lot more money in the pockets of people. You would then have to deal with sort of the fallout of, okay, well, now GDP's running 7 and, rates want to go up and we can't afford rates at 7. So we need to financially repress rates. And so the dollar's going to hit, inflation is going to pick up. So there's a different kind of issue that would be created. But I could see it playing out that way. I don't know if 50% is the right number, but like, there's a hard stop at death. And, whatever the right number is, you can look at the actuarial tables. You have a pretty good idea how many are going to die over the next 10, 15 years. And then, what happens to the money, so on and so forth. So there's a way where it can, it's not necessary, where it can start to actually look sort of sustainable again in theory. But I think the trade-off would be a much more inflationary system, especially if we're still in a regime where we're curtailing immigration and we are, reshoring. Because now you're going to have 70 trillion of spending and nobody, curtailing low-end wages and and reshoring and rebuilding at the same time too, where it's also be driving wages and inflation. So, that's like if you said, hey, Luke, flatten the curve in a capitalistic way in terms of wealth inequality. Like, Luke, 2035, this country is going to have a revolution if we don't fix the wealth inequality issue. How do you fix it in a way that is not emerging market authoritarian? We just go around and grab shit from people. And maybe the easiest way to do it would be curtail immigration, reshore, and then just let the money flow out of the boomers' pockets into their kids. And then when they want to go they want to put a roof on their house and it's $100,000, and they go, that's $100,000 is way too much for the roof. And the guy roofer is going to go, hey, call me when you're serious. By the way, in 3 months, it's $120,000. So don't dawdle. And, the guy's going to make a lot of money, and you can flatten the curve between, the asset holders that hold all the money right now and sort of the up and coming working class, and help reshore the country. It's a blunt force way of doing it, and it would take time and there'd be risk. And again, here too, you're going to have somebody basically anesthetize the bond market on a real basis. The Fed's going to have to buy a bunch of bonds to hold yields down. And that's like, there's almost no scenarios where that doesn't have to happen, in my opinion, but I could see it playing out that way.
That's maybe a perfect segue into Jerome Powell's speech last week and what you kind of see happen with the Fed. My kind of view is that all roads lead to inflation, and we're basically stuck between a rock and a hard place as far as where rates have to be and what happens with inflation, all these different cross currents. And I think it'll be interesting to see how it plays out. But I think my basic view is that anyone holding like long-term bonds as an investment, trying to hold a maturity, like you're just going to be effectively wiped out over time. But what's your kind of view on Jerome Powell's speech, where the Fed has to go, and where that all leads?
Yeah, I think, to me, the key part was he laid out where, look, I've got a dual mandate, and, whatever that means. And it's employment and it's rates, or it's inflation, excuse me. And the inflation one's getting hotter, but I'm going to focus on the employment one because it might get a little softer. That tells me all I need to know. Like, I know what to do with that. I think practically speaking, he doesn't have a choice. It's ultimately the fiscal situation dictating to him. Like, I take that. He has a choice. If he's willing to stand aside and let the treasury market dysfunction and let the bond market set prices for where the government borrows, then yeah, he in theory could be independent and have a choice, but that's not a real choice. And so, from a political standpoint. So I think that's ultimately his comments are yes, I think people are very focused on the nominal. Hey, he's more focused, he's more inflating, it's dovish, but I don't think they're interpreting it nearly as sort of broad stroke dovish as they should be, which is why he's doing this. Like, he's doing this because the fiscal situation requires this. He's financing the government. And that's fine. It is what it is. So I think that's where that was my takeaway of it. I think it's ultimately inflationary and stimulative. I think I've said for a long time, I think long-term bonds are certificates of confiscation on a real basis. They have been. I think they're going to continue to be, particularly relative to things like gold, Bitcoin, equities, home prices, a lot of different things, depending. I think that's again, it's not. I don't have anything against long-term bonds. I just happen to have believe that math will hold out, as it's usually served me well throughout my career. And the math suggests that the U.S. cannot square its fiscal circle without negative real rates at the long end. And so, that's sort of the deal. Now, facts change. I'll change my opinion. One of the things that could change that is certainly what we were talking about before, from sort of the entitlement picture, where if half the sickest boomers are gone in 5 years, then that probably changes things a bit. So, let's watch and see. It should show up in the data, but it's not showing up right now. So, I hope it doesn't. That's not what I want. I'm just, doing the math. So, but I agree with your overriding theme of like long-term bonds have to be made certificates of confiscation on a real basis for the U.S. government to make its math work.
Yeah, and you've kind of talked about all roads leading to Bitcoin and gold as far as different assets that should be outperforming over the next several years. One of the things I wanted to ask about on Bitcoin, I've talked with some other people on this, is kind of the idea that Bitcoin is turned into something that's more centralized than it was originally designed to be, and something that is, I mean, sort of like a digital surveillance gold almost, as far as what can be done there. And there's different rabbit holes people have gone down as far as that. But what's your kind of view on kind of the case for Bitcoin changing from a decentralized payment system for transactions back and forth to, okay, it's this like reserve asset, and its bull case is basically built on, hey, the number is going to keep going up?
So I think two things. I think there is some concern around centralization. With the ETFs, et cetera. It's something we have to be aware of if you're a Bitcoin holder, and is that ultimately that's a playbook that was used to sort of control gold. Is you get control along in a central vault of a quorum of the outstanding, and then you can manipulate it, control it, etc. You also need unallocated paper derivatives that there really aren't in the case of Bitcoin. So it's not a pure comp, but it is something that that bears watching as a Bitcoin holder, the ability of sort of the monetary authorities to centralize it. From a payment system, I see people make that criticism, and I disagree with it, because they say, well, it was supposed to be a payment system and now people are just holding it. That's Gresham's law, right? Like, why would I spend the good money and hold the bad until the bad money has hyperinflated against the good money? So, like, I think there's an order of operations, and oh, by the way, I think this is why a lot of the people that critique Bitcoin for this, they tend to be, against Bitcoin, or Bitcoin naysayers. But that's not something they ever bring up. Like, why would I ever sell my Bitcoin for dollars, so I could pay with the Bitcoin? That's silly. Like, how's the guy who paid with the pizza feel? Who paid 10,000 Bitcoin for the pizza? Like, how's he feel? Now, what would change? Look, if the government comes out and goes, hey, we're going to cut off, 50% of entitlement spending, and we're cutting defense budget by 90% effective immediately, like, guess what? Bitcoin's going down a lot. And we're just going we're going to go into a new Great Depression. Like, Bitcoin's going to go down a lot, at least until like the banking system starts to fail, in which case, then guess what? People are going to use it as a payment system. But base case of this sort of, continuing, nothing stops this train where they're, the debt's going to continue to rise. Deficits will be a fact of life of some size. Why would I ever store the dollars to use the Bitcoin until at least the Bitcoin was, hyperinflated against the dollar? And, I think that's partly the issue. There's also network effects that as Bitcoin continues to get bigger, then there should be more network effect. And certainly you've seen a lot more sort of network effect of like, layer 2 type development, on the Bitcoin rails over the last 4 or 5 years. I think that'll continue. But to me, the whole, why not use it as a payment? Gresham's law. Why would I pay with the good money?
Yeah, I think that's a fair point. I don't have a strong view either way on Bitcoin. It's just I find it easier to make a bull case for gold as far as the fundamentals and the like physical properties of it. But as far as your view on gold and what you see with central banks, like the continuous buying, like my view is that we're probably headed for 5,000 an ounce in the next couple of years, and probably, I don't know, 10,000 by the end of the decade, if I had to guess. But unless, like you said, there are some significant changes on what the U.S. government is doing. But what's your kind of view on gold and its basically being put back into the monetary system as like the reserve asset?
I think it's being done out of necessity. Number one, if the reserve currency issuer will grab your reserves, you can't store it in that anymore, right? So in Russia's case, So gold checks that box. If the U.S. can't, even if they don't grab your reserves explicitly, when they need to repress your reserves just to keep the wheels on the cart fiscally for themselves, as we were talking about before, there too, gold satisfies that in terms of maintaining the purchasing power of your reserves in real terms, in commodity terms, in oil terms in particular. And then I think the other really big one is something we've talked about over the last several years of multi-currency energy pricing. Like the Chinese do have a problem if they cannot buy oil and other critical commodity imports in their own currency. And the problem is nobody trusts yuan. Chinese don't want a free floating yuan. They have capital controls. They don't want to settle in debt like the Americans did, because that requires you to offshore your industrial base, which China has no interest in doing. And so they need to find something that basically commodity exporting creditors of China want. And what they want is twofold. One, Chinese goods, and then with what's left over, gold. And China has set up a system that around the world, they've got offshore yuan clearing banks in pretty much every major gold trading or gold refining hub in the world. And so they have set up this very elegant system where, you trade in yuan, you use the yuan to buy Chinese goods, and anything left over, you can show up with your offshore yuan, buy gold, and take it home. And so I think that's really why gold's going back into the system is, enlightened self-interest for both China's commodity exporting creditors, for China itself, and for the world vis-a-vis the once and prior primary reserve asset, long-term treasury bonds.
Yeah, I think that is interesting to see kind of some of these different shifts happening, and you see kind of the political power games between the U.S. and China, whether it's rare earths or basically government getting involved with like Intel or MP materials, some of these different things. How do you kind of see the China versus U.S., I guess, power struggle is the way I'll put it? How do you see that kind of playing out over the next several years?
I think the easiest outcome to come up with is I think it's going to end up with the dollar being much weaker against the yuan is maybe the easiest thing. And I think with a much higher price of gold in both dollars and yuan, but more in dollars than in yuan, and a much higher price of gold relative to oil and most other commodities. And then from there, when you get into more of the geopolitical sides, I think right now the Chinese still have a much greater leverage than most in the West are willing to admit. I think we're getting closer to admitting it from a consensus standpoint, but the Chinese were supposed to have fallen apart like 3 months ago because, quote unquote, we had all the leverage and we're the debtor, and obviously that's not how it worked out. So, there are some things that we absolutely can do that they can't. There's certain things we probably have in defense that we've not even pulled out. But I don't know that it makes sense to pull them out if we have those things for a variety of reasons. There's some control we have over certain semiconductor cap equipment and software, things like that we are leveraging. Now, the challenges that we have seen is the longer we leverage that, the Chinese are really good at sort of coming up with their own and then just cutting us off. And then they don't need it at all. And so there's sort of a fuse on that strategy. The flip side, we're kind of trying to out China as it relates to some of the industrial policy and, rebuilding rare earths capabilities, these kind of things. And we're taking steps in the right direction, but it's not nearly enough. And I'm not seeing signs that it is enough. So apparently China's got like 33 different universities with rare earth sciences degrees. America apparently has none. So you'd have to establish that, probably bring in a bunch of Chinese to establish the programs, teach the professors to teach, and then maybe in 10 or 20 years, you'll actually have a homegrown crop of rare earth scientists sufficient for our needs. The other big thing is rare earth refining, which is, even if we produce more ore, which is what we're talking about, we still got to send it all to China. They're talking about refining some here. It will be interesting to see the regulatory environment, because you're not going to want that stuff upwind to your house, your kids' schools. It's very, very nasty stuff. And it's, it is part of the reason why the government pushed a lot of this stuff out in the 70s and 80s was, we've had clean air, relatively clean air and water for so long, we kind of forget what it's like. But like, I'm in Cleveland, like the friggin' water or the friggin' river caught on fire in the 70s. So like, there's a reason that was. It's because we were making a bunch of steel and all this stuff. So it is, when I look at the leverage, I think in the short run, China's got a lot more leverage than expected. And I think probably modestly more leverage overall. And then it really comes down to how fast the U.S. can work. How does the U.S. political process help or at least not hurt that work? But to me, the two clearest outcomes, I think gold's going way higher, and I think yuan's going higher against the dollar.
Yeah, I think it is interesting to see all these different things because, like you said, I think the consensus on China, like there's been people talking about how China's going to collapse for like the last 10 years, really, but it has been fairly vocal this year. But you mentioned oil to gold a couple times, and that's an area that's of interest to me for a variety of reasons. But the thing that I find interesting with that is you see kind of the long-term, like 50-year chart of where that ratio is traded. And it really, anytime you get above 40 or 50 barrels to an ounce of gold, it tends to mean revert. So if you get into why you think that oil to gold's going, that ratio is going to blow out, I think that'd be an interesting back and forth.
Yeah, I think it's going to blow out ultimately over time or continue to, right? It's gone from 8 to 55 over the last, call it 17 years, 8 barrels to 55 barrels an ounce. Is that we know the world is moving to other neutral or other reserve assets, right? They're moving to gold as a reserve asset. And we know that China is pricing the marginal barrel of oil in Chinese yuan and net settling in gold. And so once you have multi-currency and net settling in gold, you're effectively settling oil in gold at a net central bank level. And on a physical only annual production basis, when this process started, the oil market was 15, 20 times bigger than the gold market, annual physical production terms in dollars. It's probably still 10 or 12. Maybe it's 8. But that's, what does that mean? Like take 8 to 10 to 12 pounds of shit and put it into a 1 pound balloon. What happens to the balloon? It expands dramatically. That's all we're watching with the gold to oil ratio is, oil is way bigger than gold and it's trying to fit into gold, and gold is getting bigger as a result. And that's why it's gone from 8 barrels an ounce to 55 barrels an ounce. I think it's going to 100. I think it's going to go to 150, 200 over time. I think that's a pretty good setup for a lot of different people, but I think that's I think that's why it's happening and why it'll continue to happen.
Yeah, I think it is interesting. How do you square that view with like the underinvestment CapEx, like what you see going on in the shale patch since April, where you just see rig count off a cliff, frac spreads, like basically all the leading indicators where people can talk about efficiency gains in the Permian, but at some point that'll override whatever efficiency has been squeezed out. So like, how do you, is it basically just, you think gold is going to keep roaring higher quicker than oil, or do you think that oil can sit here at 70, like 65, 70 a barrel indefinitely?
I think you can sit there indefinitely, but think about your question. In what currency, right? Oil's now being priced in 2 currencies. So think about if shale goes offline, oil spikes. What happens? Inflation's going to pick up. Oil's going to pick up. Bond market's going to crash. And what are the authorities going to do? They're going to print money. They're going to do, right, which is good for gold. So I think that's number one. But bigger picture, if that happens, if you're China, right, put yourself in China's shoes. If shale rolls over and dollar oil prices start to pick up, what do? Well, I would call the Russians and I'd say, look, we've got all this gold and we can buy more in London because these guys will sell it to us at 55 barrels an ounce. So let's use 50 barrels an ounce. Let's just say it's at 50 for easy math. The Brits will sell us gold at $50 or 50 barrels for 50 barrels of oil. Okay. I'm going to short 50 barrels of oil in London. and I'm going to buy an ounce of gold in London. I'm going to bring the gold to China. I'm going to say to the Russians, hey, will you do it for 60? Russians will be like, hell yeah. Great. There's 60. Why are they going to do it at 60? Because the Russians have converted their dollar reserves into gold reserves. And so their gold reserves will go up a ton. They will be effectively facilitating the repricing of their gold reserves using their oil. They'll be getting paid on a real basis. And in doing that then throws the question, right? So now Russia sells the oil at 60. Russia gets the ounce of gold. China gets the 60 barrels. China takes the 50 barrels they shorted in London and covers their short. And now China's left with the 60 barrels left over free. Great. Let's take it back to London. We'll use this 10 barrels as collateral. We'll do it again. And to what end? Why would they do this? The end is making sure that Russia's interested because they got a bunch of gold, because they want to make sure they can never again be sanctioned by the West for a political reason. The Chinese want the same, and the Chinese need to have low price of oil in order to facilitate their economy, keep it from falling over. So they would use, if shale rolls over, in my opinion, you're going to see maybe you'd be a brief moment where, yeah, if it went over shortly, yeah, you could see the gold to oil ratio go from 50, 55 to 40, 35. I mean, that's a big move in the ratio, but like, I don't think it's ever going back to 8. I think it's going back to 15. Because ultimately that implies a price of oil that is creating problems for the Western bond market, number one, but more importantly for China and the reserves, the dollar reserve burn down. And they're just going to switch to pricing in yuan, and the yuan's going to get converted into gold. So basically, anytime you hear, because China can run out of dollars, they can't run out of yuan. And so basically when China does that to avoid running out of dollars, start buying it more in yuan, though nobody wants that yuan, what are they going to buy with it? They're going to buy gold. And so basically what you're going to do is you're going to start having oil bid more aggressively for gold through Chinese yuan. So I think you'd actually, you maybe get a little, and then it would take off even faster on the upside for the gold to oil ratio. I think you'd set new all-time highs in the coming months or quarters.
One of the other topics you talked about, and this is sort of separate from the gold to oil ratio discussion, is how the manufacturing indices here in the U.S. are kind of tied to drilling activity. And it might have been, I don't know, like 6 months or a year ago that I was hearing you talk about this. If you could elaborate on how that kind of shows a pickup in activity and how it kind of ties in with the different manufacturing numbers, because I think that's one of the things where, like, you see all these different economic stats, and I look at some of them, and like CPI, for example, is just a load of crap as far as actually gauging inflation. But like, how do you compare those and tie those two together?
Yeah, it's really something I began noticing during the shale era, right? So like there's oil drilling and then there's shale production, and shale is much more like manufacturing oil than it is drilling for oil, right? So take a look at the industrial intensity of shale production, right? So you've got all the, the oil country tubular good pipe, obviously. You got the rigs, you got the fluids. All the fluids are getting moved on tankers. Every tanker truck's a Class 8 tanker truck. It's going over roads that are just getting torn to crap by these trucks running over them. And so you need to order more. More asphalt, production, concrete production, rebar for the concrete for the roads, that the Class 8s that are moving the fluids, that the fracking fluids or the dirty water to wherever they're going, tear up the roads. And oh, by the way, all that stuff's got to move on a truck as well. So there's another heavy duty truck. And then, when you've maybe in certain areas, you do build a pipeline. Now you got to build pipeline, right? So you can see how energy intensive this is. Maybe looking at it more simply, you've probably heard people say energy return on invested energy. Look, energy, early oil was 100 barrels, a barrel. And now, shale's 12 barrels or 15 barrels a barrel or 20 or 8. I don't know what the number is, but it's way lower. Another way of saying energy return on an invested energy declining is overall manufacturing intensity of oil production rising, right? So basically, EROIE going down means you've got 16 heavy duty trucks to make the road, fix the road, pave the road, move the take the fluids, all of this stuff. And so, when there's just simply, look, the United States is producing what, 18 million barrels a day of oil, and I want to say 14 million of it's oil and related liquids, something like that. Find me something else that the U.S. produces in that scale on the industrial side. Cars? The U.S. has been selling 15 million auto units on average, 15, 16 million, since I was 24. When I started in this business, when I was 20, when I was 20, I think they were 13 million. I remember the year I got married when I was 24. I think the SAR was going to have a record SAR. We're going to be 15 million SAR. 30 years later, guess what the SAR is? 15 million SAR. Maybe it's 16. Maybe we've had a few good years of 18 or 20 or whatever when we've given this shit away. So autos have declined as a percentage intensity. We don't make as many autos. We shipped all that stuff to Mexico and to China. Airplanes. Airplanes was another big one. Early in my career, there was a famous in related to the Asia crisis in late '97. Right, you had the Asia crisis, Southeast Asia crisis, and I'll never forget. November of '97, Boeing comes out and shocks the world. They're like, "Oops! We got to cut our order delivery by 30%." And by April, industrial indices were collapsing. They were recessionary. So autos used to be a big one. They still are big, but from an incremental standpoint, it's 15 million for 25, 30 years. Boeing. It's still a big one, and they're still plugging along despite everything. And then the list starts to get really short of things we do a lot of manufacturing of. Until the next biggest thing is arguably oil manufacturing, and it is by far and away the biggest swing factor. Right? We've seen that. When they laid down those rigs because oil's too low, it ain't well, let's just order some more pipe and fix the shit stops. So pick up the phone, call the heavy duty truck guy. We're done. We're out. We'll call you in another 6 months when the price comes back up. So that's why it is such an important swing factor that is still underappreciated, which kind of surprises me, thankfully, because I can I get a lot of mileage out of whipping and driving that. Oil goes to 60 and Bessen's like, hey, we're going to get inflation down and American manufacturing to come back. I'm like, well, you might get inflation down. American manufacturing coming back with oil at 60, dude. Good luck. And sure enough, where's the ISM? 48, 47. It's going to stay there till oil's high enough to drive incremental drilling.
Yeah, I think it is interesting too when you look at the amount of water produced out of the Permian and all the stuff with the frac sand, all these different things. It's not like you pop a straw on the ground and you get the gushers from 100 years ago you used to see in California or places like that. So it's
there's a reason why people I live in Cleveland, right? We got nothing but fresh water here. People you should send that to the desert. And that's anyone tells you that, you just hang up on them. They're like, no. But it's the reason it's not done is water's heavy. It takes a lot of water to pump 1 gallon of water up, 100-foot hill. And by the way, from here to there, it's 5,000 feet, right? So, this is extremely energy intensive. And by the way, where's that energy come from? Oh, it's usually oil itself. Where'd that oil come from? Well, that came from the shale well over there, and then the refiner, and then the truck that took it there. It is a very self-referential,
it's a feedback loop.
That's exactly what it is. That's exactly right. And if people have a hard time with feedback loops. They see Wall Street's very good at first derivatives, and then second derivatives are and third derivatives are terrible.
Yeah, no, it is one of those things where you look at it and you see the fast decline rates and what happens when oil's at 55, 60, 65. And I just think they're kind of stretching the rubber band. We'll see where the price heads as far as in dollar terms over the next year and a half. But I think it'll be interesting to watch because you're just you're not going to see the U.S. produce more oil if oil stays here at 65, 70. I just think that's it might get gassier, but you're just going to see the decline rates of these wells, all that stuff continue to bite. So we'll see how long it
Yeah,
takes. But
I think you're right. And that's ultimately a dollar issue, right? Because the Chinese are like, I'm not paying more than whatever, the yuan equivalent of $50 a barrel or $60 a barrel, right? Maybe that's probably not the right number. China's not going to pay more than $65, $70 a barrel in yuan terms. So if you want higher, like you've either got to get more efficient or, higher production. You got to get more efficient, or you're going to see your production roll over and keep rolling over, or you got to weaken the dollar a whole bunch against yuan and by extension gold.
The before I get into kind of broader equities, S&P, all that stuff, I want to backtrack the precious metals a little bit and talk about silver and actually platinum, because platinum is the one where it doesn't get nearly as much attention as gold and silver, just because of the size of the market and all these different reasons. But I look at that as kind of the very asymmetric setup for all the precious metals. But I know you've kind of talked about silver a bit, so let's maybe start there. What's your kind of view on silver relative to gold and where all that heads over the next several years?
Yeah, I like silver. I own a little silver. I mean, it's like a stub piece. I've owned it. I bought a bunch. I bought a bunch in 2008, 9, like low single digits, 11, $12, or not low, excuse me, high single digits, 11, $12, silver. And I sold it all in April 2011, over $40. And I took the money and bought a farm. I never really went back to silver till probably 2018, 2019. I bought a little bit at, 18, 19, something like that. And I still hold it. Like, I like it. I think it's going to do well. The thing about silver is that industrial component, right? Whereas if silver gets too expensive, like we can't make iPhones, we can't make solar panels, we can't make electronics without the, creating a inflation feedback loop. And unlike that with gold, you price gold at $1 million to like pick a random, like stupid big number. Not that I think it's going there, but like, so what? There's a few niche applications that gold's used in, but by and large, like nobody cares, right? It's purely a monetary thing.
Peter Schiff cares.
What's that?
I said Peter Schiff cares. Sorry, I couldn't help but interrupt, but go ahead.
He'll care. And I think the same's kind of true of platinum, right? Obviously, you use catalytic converters is its biggest use, or one of the biggest use for internal combustion engines. So there's this industrial component to it alongside the precious metal side. I think both of them will do well, but I just think ultimately, in the context of a world where I think the first principal driver is global sovereign debt crisis, then ultimately that will continue to reinforce itself over everything else. And if that's the case, central banks need something to recollateralize the system. And the only thing they have on their balance sheet is gold. And so basically, I think, sort of gold to silver ratio going up, to where the historical levels where it is not, in my opinion, as much a sign that, hey, they're wildly mispriced relative to each other. To me, it's more a sign that, the Western sovereign debt bubble bursting is beginning to be priced into the gold silver ratio. Basically, markets are beginning to go, gold is just going to go up and up and up and up and up, particularly as it goes back into the system as a neutral reserve asset. And so I think, like I said, I think both gold and platinum will do well. But I would rather, over the course of this long cycle, next 5-10 years, I'd rather own gold. I think gold will outperform both, even from these levels.
Yeah, I think it is interesting. Kind of the overarching theme I'm getting is that gold is sort of the release valve they're going to be using, whether it's gold-backed bonds or revaluing the gold, whatever that mechanism may be. But it'll definitely be interesting to see kind of where that heads. As far as S&P 500, the way, like, I look at the valuations and they don't make a whole lot of sense to me. But at the same time, I kind of view what's happened to kind of the broad market is they've almost turned it into like this giant US savings vehicle where you can't really let the markets crash or go down for any extended period of time without that causing significant problems for a variety of reasons. But I guess the big picture question is, how long does it take for markets to get back to allocating capital based on fundamentals, like what a business actually does, versus okay, you have the passive bid and the feedback loop there, and you have what the market has kind of turned into, where it's just the tech piggy bank, basically, of U.S. assets.
Well, you can't do it until you significantly devalue the U.S. government's debt, because right now, if S&P falls, the key marginal driver to U.S. tax receipts is a stock market through the consumption link, non-withheld, is where it's shown in the tax receipt numbers. But then also through stock comp, non-exec stock comp on top of that. So, basically, if stocks fall 20% and stay down, receipts are going to be down over year within, I don't know, 6 to 9 months. And then once that happens with where we are on the deficit side, then you're going to start having a recession where rates go up because the U.S. government's going to crumb people out. And then the dollar's going to go up. Then foreigners sell treasuries to raise dollars. Then yields go up more and stocks go down more. You go into a debt doom loop. So until you significantly devalue long-term U.S. debt, the S&P is basically, something I highlighted way back in it's probably 2014, maybe it was 2015, but maybe it was even 2016. But the point is that our view was like, look, S&P, long S&P, short TLT was like the trade. And it was like, it is the absolute, and that's it. Like long stocks, short, long-term treasuries. And that's what's going to happen because U.S. policymakers have allowed this to evolve into exactly that, the key marginal driver to U.S. consumer spending and therefore U.S. GDP and tax receipts. Now, the tricky part is while you're also trying to get people to reshore and learn to weld and manufacture, like who the hell needs to do that when, the government needs probably 12, 15, maybe almost 20% a year in the S&P just to make the fiscal math work at this time. So like, if I can make 15% a year over time, why do I want to go work at something? I'll just sit here and collect my S&P welfare. So it becomes a policy issue at some point. But yeah, I think ultimately that's going to continue to be kind of the name of the game for, a period of time.
Yeah, I think one of the other interesting things too that I've been looking at recently is what's going on with AI, but really these language processing models. And I kind of look at the CapEx that's being dumped into that sector as a ticking time bomb almost. Because, I mean, you look at kind of past examples of it, and you can kind of go into the capital cycle, all these different reasons why it's going to end poorly. But what do you think the impact of like this CapEx boom from the tech companies is going to be if and when it all goes sideways?
I don't know. It's a really interesting because when we had the fiber optic bubble or boom in 2000, like they turned the lights off on the fiber, but the fiber was still all there, right? So, 2-3 years when the traffic started to warrant again, you can make the argument that sort of, internet bubble 1 sort of set the stage for internet bubble 2, right? Because without all that fiber that was laid, et cetera, and then left dark, you probably couldn't have grown, web 2.0 names as quickly. Same thing with the railroad bubble, right? The challenge with this one a little bit is the useful life on this stuff is much shorter. It's not like you put a bunch of chips in and in 5 years, they're still going to be the best chips. Like, it's probably not going to be true. And that's a little bit of, I think, a difference that's not as appreciated. Jim Chanos on X, famous short seller, had a really good write-up a couple of weeks ago about one of the big hyperscalers who pointing out that they were depreciating their CapEx marginally at like a 22-year life. And like this stuff might not last 3. And his point was like, look, if I'm right that this is what they're doing, then like they are wildly overstating their earnings. Now, they're wildly understating their cash flows because DNA is an add back, right? So the cash flow would actually be better. So it's not like and they're not borrowing to do it. A lot of it's just funded out of CapEx if I'm to understand properly. But you're quickly getting into a thing where you're competing against the Chinese government as a private entity. And like, I could take you to a graveyard of all of the U.S. companies over the last 25 years that tried to compete against the Chinese government as a private entity. And so it raises questions like, are we going to nationalize the hyperscalers? Are they too big to fail? I would say they probably are too big to fail. If AI is actually a thing, and I think it is on some level. That's probably what it looks like, is you probably get a wobble, and these guys have a couple of bad quarter, or even just a bad quarter or whatever, and then the federal government, Trump comes in, it's like, I'm going to buy XYZ hyperscaler. We're going to buy 15% of fill in the blank hyperscaler because AI is important. Like, you watch, that's what's going to happen. I'll bet you that's exactly what they do. And is that the right thing to do? I don't know. Here too, I don't know if it's right or wrong, but I know what to do with it.
Yeah, it is. I can't remember who was saying this, but it's the old saying of when China walks into a room, profits leave, basically. But I think it is a setup where I've done some digging into like the chips and how quickly they are outdated, and like there's some of these things that don't even last 12 months. Like, it depends on how fast stuff is moving, and I think the difference, to go back to railroads and the fiber optic stuff, is that was like a foundational infrastructure. This is something where it's like you have to refresh it over and over and over. And I think that's going to be interesting to see how it plays out. And I just look at the way some of these valuations look on the big tech stocks is, yeah, maybe they are too big to fail and we can't let them collapse. But I look at a lot of the money going into some of these areas, and it just seems like a speculative excess, while there are other places in the economy that I think would be a better place to be. But we'll kind of see where it goes. So do you have a long-term view on AI being as impactful as some people think? Because I kind of, from a philosophical standpoint, I don't think some computer engineer is going to take like the spark of life or consciousness and plug it into a machine. But what's your kind of view on that? And like, do we get general intelligence, or is it basically a processing model that can go through vast amounts of data very quickly?
I don't know if we get general intelligence or not. That is above my pay grade. What I can tell you is I'm seeing instances where the data, the ability to go through lots of data really fast is already creating disruption. I had lunch with a Fortune 50 executive friend of mine a week ago, and they have fired all of their translators around the world, multinational, global. Why? They don't need them. They have AI can do all the translation faster, cheaper, free. They're saving well over $500,000 right off the bat. A year. I'm seeing, an AI sort of aided cashier at a major Southeastern United States fast food restaurant. Used to be full of, a bunch of 18 and 19-year-old kids. And now there's like 2. I went to a Midwestern University campus bookstore. Put your stuff on them. Nobody, just one security guard out front. Nobody in the store. Put your stuff on the mat. Put your stuff on the mat. Boom. Here's what you ordered. Here's a total, done, gone. Pick them up, leave. Thank you. Tap your card, right? So like self-checkout has always been a pain in the butt. That was the first time I've ever done self-checkout where I was like, whoa, like 90% of cashiers are going to be gone in 5 years. And so I'm seeing all of the, I look at, 1990, the biggest employer in the US was manufacturing as an industry. In 2024, 38 out of the 50 states, biggest employers, healthcare. And it ain't docs and nurses, it is administrators. And like, do I think AI and faster data processing could disintermediate a bunch of people in healthcare administration? I know how friggin' inefficient that is. Like, that is a layup. And the problem is that this gets back to the fourth turning of like elite overproduction. You went to college, you've got $100,000 in student loans, you're a healthcare administrator, you've got a mortgage, you've got kids in school, you've got 2 car loans, you got a credit card, and now AI just took your job and his job and her job. and their job. What do? You stop paying on your mortgage. You have to. I saw this in the Rust Belt when we sent the jobs to China. It's no different than sending the jobs to China. Then what do? Well, they going to let the banks fail? Are they going to let these consumer credit card companies fail? Because they just have a sliver of equity. Well, guess what the banks hold as their equity to sell for loan losses? It's treasury bonds. So now we're going to have a recession where employment's going up and rates are going up. So the U.S. government's receipts are going down and their interest is going up. So paradoxically, to me, I don't know on AI. To me, it's two things are very obvious, in my opinion. At the low end and into the medium end of white collar, it's going to be extremely disruptive and deflationary to wages. And we're in a highly leveraged system where everybody's got a loan on something and they will not be able to pay it. And so when that happens, the authorities are going to be right back to 08, print the money or let the system fail. And for my gold holdings, my Bitcoin holdings, I don't care either way. I win either way. And that's why I sort of, I've really been harping around AI. Like, I'm not smart enough to know the technological stuff about what it will do, but I can see what it's doing. And I have this unique ability for whatever reason. I see the exponential function happen better than most humans. I don't know why. And I can't tell you exactly where it is, but I can just see what's happening and say, oh my God, that's a huge problem because there's going to be second and third and fourth derivative daisy chain events. And I look at AI and go, they're going to have to print, so they're going to have to fully reserve the debt. A debt-based monetary system and banking system is fundamentally incompatible with an even modestly functional AI, large language model, data processing system. Everyone who thinks they're, and I can tell you how people react when their jobs are not safe. Because again, the beautiful thing about being in the Rust Belt, I lived through this once already. Like, this is not my first rodeo of watching something really cheap and efficient and scary take your job. And then the political fallout. And then, 1 million people die of drug overdoses from 2010 to 2022 in your cities. Like, I've seen this before. I know how this goes. And so I think the easy way to play is you own gold and you own Bitcoin. You wait for the authorities to print money to back out, to bail out their banks. And the rest of it, we'll see. Then it's just a one decision game. Is it real or is it not? We're going to know pretty soon if it's real or not. It's looking more real by the day, in my opinion. Setting aside the craziness of AI, right? Like, the internet was real. The spending was at first, but you had one time to get out of your B and C mall before it became, here's what the value of your B and C mall did. It was like, they priced it right away in 2000, 2001. And then it was like, oh, wait, it's not so bad. And then like Eddie Lampert and all the guys are like, oh, these malls are gonna be fine. We can cash flow them. And then it was just like, right. So I think, that's probably instructive as I talk through it. But to me, I just think AI means whatever gold ratio, whatever gold and Bitcoin holdings you have, it should be bigger, within reason. But most people barely own any gold. They don't own any Bitcoin. And like, what AI is going to do, quite possibly, like, it should be their biggest position.
Yeah, it is interesting. I guess the one thing that I'll throw in is I'm kind of wondering what happens as these models get more expensive to run, whether it's, okay, you now have to pay $500 a month to use this, because they are being subsidized in a variety of ways. But what's your kind of view on how that and energy costs might feed into your view on AI? Is there like a point where it becomes cost prohibitive and we kind of reverse that trend? Or do you think it is, because I kind of view it as a commodity service for the most part. Like, most of these models are pretty much interchangeable. So I don't really see a ton of pricing power there, but if you look at what it might do to energy costs and all these different things, do you think that's something that might offset how many jobs get lost from kind of the rollout of AI?
Maybe, and maybe here, right? So look, DeepSeek, if DeepSeek is free, that blows up the whole friggin' revenue model, right? Or whatever Chinese AI they have that's allegedly testing very well. We're already hearing about it here in Columbus, Ohio, right? We've got all these hyperscalers. People are getting their energy bills and they're like, what the hell? You've seen it up and down, the East Coast in the U.S. There's been some concerns. A lot of these things are around Virginia and the CIA, et cetera. Yeah, it's an issue. And that's where, I think it's one of these things that could tie into the fourth turning, which is like the people are going to go, I can't afford my electric bill. And the powers that be are going to be like, well, turn off your lights and turn off your AC. And sorry, because we need this stuff. And it gets down to the very fundamental, dynamics of who runs the country, right? If Amazon and Google and Facebook or Meta or whatever they need the power, and grandma is going to die in the AC. Without AC in Texas, what do we do? We can be hopeful that maybe there's some, modular nuclear reactors that can be, ratcheted up quickly. But this is another way that China's ahead of us. Like China's got plenty of capacity over there. To me, for AI, I do think electricity capacity is going to be probably your first constraint, probably by 28, 29, maybe sooner. From a pricing standpoint, to your point, and I think then you kind of overlay that with us. Where's the biggest clusters of U.S. AI? Where's it at? It's in the Middle East. Why'd we do that? Because we couldn't do it here. That's my guess. So, yeah, I don't have a great answer. I mean, I think it's an inflationary impulse. I think people are used to energy bills not doing much. They're starting to do a lot. It's starting to anger people. They don't have the disposable income. What are they going to do? Show me a time in the last 35 years the American government's done something for its people as opposed to its corporations and its too big to fail institutions. I'll wait.
Yeah, not in my entire life.
Right. So again, it can be a fourth turning accelerant. I don't know. It tells me there's going to be a lot more Mamdanis. Does tell me that. Right. You could run New York on a platform of, hey, I'll turn the AC back on and turn the AI off.
Needs to get in the gym though. That was pretty bad the other day.
I did see. Yeah, come on, man. That's like, I'm 50. I can still rattle off 10 pull-ups. I can do 45 push-ups without stopping, man. Come on.
Yeah. No, I think you're right though, where these political changes will be something that happen quickly, and I think the attitudes on a variety of different topics, whether it's like economic structure or forms of government, all these different things, I think whether you look at people who are on the right or left, like the younger generations are not interested in the status quo, and where that heads, I think, is going to be interesting as things kind of turn over generationally. But I don't know if you have a strong view on if there's a potential fix or if there are things that can be done, or if it's really, we're basically going to keep kicking the can down the road on a variety of different issues until it's okay. There are the so-called like pitchforks and torches that come out.
I think there's always things that can be done. I do think that our system is tailored to kick the can being, the default option for as long as it can be done. I'm optimistic there actually won't be pitchforks and torches, because after what I watched over the last 5-6 years, like, even you reference in Mamdani, right? Like with he couldn't bench press 135. That guy's gonna, get out there and lead a protest. Like, come on. I saw, without getting into all the specifics of it and getting political, like 80% of Americans will do whatever they're told. Whatever the evening news or their team tells them, that's what they'll do. And so, I think the leading indicator on that will be somebody's team saying, hey, get a torch, get a pitchfork, and we're going, and here we go. But I don't see, I think the intelligence community is acutely aware of that. And, for example, I think there's a reason why the No Kings protest has been like a bunch of grandmas, right? Like, and not what the summer of 2020 was. I don't think that was an accident. The fact that it's been a bunch of grandmas holding a sign, which is, oh, cute. Look at grandma protesting. Okay, wave, kids. I think there has been, any potential malicious actors that wished to leverage that for their own purposes probably got a visit.
Yeah, no, those are the demographics, not the demographics I would be worried about, whether it's the political grandmas or people who shouldn't even have the right to run for political office. But that's a separate issue. But I think the thing that will be interesting is I'm not sure if you have an opinion on this, but when you see some of these different changes and the kind of media landscape, and there's no kind of unifying narrative where all these different things, like everyone's kind of in their own echo chamber, do you think that will play a part in kind of where this heads as far as, okay, it's not like everyone either watches Fox or MSNBC, everyone's in their own social media feed?
I think it could. I think quite possibly it's driving sort of a radical decentralization around, basically the only people you trust anymore are the people like in your immediate circle. And even then, not in some of those cases. More so than sort of nationally accepted media figures, because like I know things that happen to people I know, and these national figures are telling me that that's a lie and a conspiracy theory and never happened. And I know lots of people that have said the same thing to me. And so when that happens, it does accelerate the fourth turning from a standpoint of just completely discrediting, the establishment media, which I think they've done a fantastic job of doing to themselves.
Especially over the last 5 years.
Oh my God. Like, yeah, last 5 to 10 years, it's just been self-immolation. And some of it accelerated by the internet, right? Like my friend, Balaji had a great point that like the internet is doing to sort of that class of people what China did to the working class of people, 10, 15 years prior.
Couldn't happen to a better group of people. I feel so bad for them.
I have some good media friends. So I don't want them to be uncomfortable, but I do think it's challenging, right? It's the challenge of this time of like, everything's changing all at once. And so, yeah, I do think it leads to this sort of radical decentralization of like, I know what I know, and you're not going to tell me not to believe my lying eyes. And I think there's a growing number of people now, I know what I know, then everyone kind of fragments into some echo chambers of their own, and they believe what they believe. And, it does make things a bit more challenging, and, we'll see how it goes.
Yeah, it definitely is. We definitely live in interesting times, I think, is the short version. But is there anything we kind of skimmed over that we should hit on briefly before we start to wrap up?
No, I think we've covered a lot of ground. So no, that's I appreciate you having me on.
Yeah, thanks for taking the time. I really do appreciate it. If my listeners are looking to find your work or your social media, where can they find you?
Sure. FFTT-LLC.com for more information about both our mass market and institutional research products. And at Luke Gromen on X is my feed there.
Yeah, awesome. It's lots of interesting stuff to read. But I guess before I do let you go, I do have to ask my traditional closing question, which is, what book should I add to my reading list? I know you mentioned End Times by Turchin at the beginning, but you have another one that might be worth a look.
Yeah, if you haven't read Lords of Finance by Liaquat Ahmed, you should immediately. Okay. It's really good. It's basically like a roadmap for what's going on, and has been for about 10 years. I mean, it's just like, oh, okay, well, here's what comes next. Of course, there's slight variations on the theme, but human nature never changes. It's all fear and greed, and so it's very useful. Sort of as it went from 1918 to 1939. Yeah,
I think it'll be interesting to see where things head, but there are some things that I think a lot of people are missing, and definitely gave the listeners a lot to think about. So I really do appreciate it. But I think with that, we'll be wrapping up. Thanks for stopping by. We'll see you next time.